Hi, good afternoon, everyone. The time now is 1:01 p.m. We're going to begin our webinar already. In case you are first time joining us, this is part three of four parts in total of our Hong Kong Value Stock series. Please, if you have the time, do consider joining us next Thursday as well. That will be the last part of our Value Stock series. And also, if you had not joined for the first two sessions, some of the counters that we have already covered would be Chow Tai Fook, 11 China, Sinopharm Group, and BYD Electronic International. Today, Mr. Wong will have some more counters for you. I believe today there's three counters that will be covered. So it's going to be a very informative session. And without further ado, I would like to hand over the time to Mr. Wong to begin the webinar. Mr. Wong, thank you.
Thank you. Good afternoon, everyone. Yes, today it's our part three, Hong Kong Potential Value Stock Series part three. Unlike the part one and part two, where we only pick two stocks, today we have picked three stocks to present to you. Okay, a review on the two stocks we picked last week: Sinopharm 1099. And BYD Electronics 285. Both of them did well this week, with Sinopharm hitting 2250 Hong Kong dollars today. And Sinopharm it will be included, as I mentioned last week, it will be included as a Hang Seng Index constituent stocks this Friday. So its share price strengthened this week, breaking the resistance of around 35 Hong Kong dollars and hitting a recent high of 38.25 Hong Kong dollars today. Okay, wish you have entered these two stocks after our presentation last week. Okay. The three companies we are going to talk about today, among the first one will be Bank of China, which you may be familiar with. Bank of China is the first large commercial bank in China that has engaged in integrated operation. Let me move this a bit. Yeah. Oh, sorry. With businesses covering investment banking, asset management, insurance, direct investment, leasing, consumer finance, technology finance, among others, which enable BOC to provide enterprise clients with comprehensive financial services. As at end of June 2023, at a total of 532 overseas branches in 63 nations and regions, with the number of overseas branches proportion of overseas staff to total staff geographical coverage, ranking first in the banking industry in China. So compared to the other three state-owned banks, ICBC, CBC, and Agricultural Bank of China, Bank of China is more international, more exposed to other overseas branches. It has two listed companies in Hong Kong. BOC itself is listed as H-share in Hong Kong, and its subsidiary BOC Hong Kong 2388, the ticker is 2388, is also listed in Hong Kong. Okay, but today we're talking about the parent company, BOC, Bank of China, 3988. Okay, this is the financial performance in the first quarter this year. Revenue decreased by 3.1%. Actually, other state-owned banks also saw declines in their revenue in the first quarter this year due to the economic slowdown in China. So average decline was around 4 to 5%. So BOC's revenue declined 3.1%, outperforming slightly its peers. Operating profit was down by close to 10%, and operating profit margin also down 6.8%. Net profit dropped less than the decline in revenues. Net profit only dropped by 2.9%, and net profit margin saw a slight increase. Earning per share dropped 5.26%. ROE and ROA are 2.12% and 0.17%, respectively. Okay. This is last year, 2023 financial year. So last year you saw all of the indicators saw growth. For instance, operating income grew by 6.4% year on year. Net interest income grew by 1.58%. Net fee and commission income grew faster. This is also one distinct feature about BOC is net fee and commission income grew much faster than its peers. Net fee and commission income grew by 5.3% last year. And PPOP grew 3.68%. Profit after tax grew 4%, and profit attributable to shareholders of the bank increased by 2.4% last year. So this is his financial results last year. Compared to the other 5 state-owned banks, namely ABC stands for Agricultural Bank of China, BCM is Bank of BOCOM, Bank of Communication, ICBC, Industrial Commercial Bank of China, PSBC is Postal Saving Bank of China, 邮储银行, CCB, Construction Bank of China, and Bank of China. You can see red line here, revenue growth, it outperformed in 2023, especially when the other 5 saw decline in revenue growth. Its revenue actually picked up, saw growth in its revenue and outperformed the other 5 competitors. Okay, it is quite diversified in terms of non-interest income. So its non-interest income ratio is less dependent on, compared to the other 5 state-owned banks, it's less dependent on interest income. You can see non-interest income accounted for 38% of its revenue, while the average for the other 5 state-owned banks is around 20%, much less than that of Bank of China. And the fee income breakdown here in the first half of 2023 is also quite diversified. You can see 25.4% comes from agency business, 17.1% comes from settlement and clearing, 13.4% comes from card businesses, and 12% from credit commitment, 11.6% from consultancy, 8.2% from custody and other entrusted business. Also, income from foreign exchange, buying, selling price difference, 5.6%. So one distinctive feature about Bank of China is non-interest income accounts for nearly 40% of its revenue, and non-interest income itself is very diversified. Okay, in terms of deposits, Bank of China's share of demand deposits in its total deposits was 42.5%, which is the middle level in the industry, with the personal corporate demand deposit ratios at personal demand deposit is 37.4%. Corporate demand deposits is 52.4%. So demand deposits are also similar to fixed deposit. If the ratio is too high, the profit margin will be lower for the bank, because banks pay higher interest rate to fixed deposits or demand deposits instead of current savings. Okay. Manageable asset quality risk. NPL ratio is better than the average and also declining over time. On the left-hand side, you can see the balance of non-performing loans. Although balance of non-performing loans is growing because the loan portfolio is also growing. The NPL ratio actually is on a downtrend. You can see from 1.4% now dropped to 1.2%. And the right-hand side, it's a comparison of the NPL ratio among the 6 state-owned banks. It ranked the 5th, only slightly higher than PSBC. PSBC has the lowest NPL ratio among the six state-owned banks. The other 4 state-owned banks, their NPL ratio is exceeds 1.3%, while Bank of China is below 1.3%. Okay. But lower provision coverage ratio than peers. Its coverage ratio is likely less than 200%, while PSBC has the highest provision coverage ratio, more than above 350%. The rest ranges between 200 and 250%, but all of them are above the mandatory requirement coverage, provision coverage. Okay. Capital level, total capital ratio is 18.5%. So you can see in the last 2 years, its total capital ratio is on the rise. And Tier 1 capital ratio, represented by the blue line, also rose from 13.8% in the first quarter of 2023 to the first quarter this year to 14%. 14%, okay? And CET1 capital ratio also improved from 11.63% to 12.02%. Okay. Interest margin. Interest margin, this is the growth rate. So you saw postal state saving bank saw the fastest growth in interest margin, but it's also coming down after the rapid growth. BOC, the interest margin actually remains quite stable compared to the other 5 state-owned banks. It does not it has not posted as rapid growth as PSBC, yet it remains stable over the last few years, the net interest margin, the NIM. Okay, but interest margin is expected to narrow because return on assets in mainland China is under pressure. As the market expects rate hikes to end, the company has been making active allocation adjustment on the asset side to help the property market. China has been lowering the mortgage rates and LPR repricing. This has a negative impact on banks as a whole, because to help the property market, the Chinese government has signaled commercial banks to lower the mortgage interest rates. Okay, and on the other hand, the Fed's rate hikes have markedly driven up interest payment costs, coupled with the repricing of deposits after maturity. So fixed deposits after maturing, the interest rate tends to move up. So this also will exert downward pressure on the interest margin. Okay, the share price outperformed the market. You can see since January this year, keep rising to now is about This is up to early May. We have not updated because we prepared this PowerPoint in early May. Now the share price has risen to close to $4, and now recent correction has brought the its share price to around $3.75. Currently, it's trading at around $3.75. Okay, now the P-book band, price to book value, is trading above fair value. Fair value is 0.407 times. Okay, now it's trading at around 0.41 times P-book, price to book. So we will recommend investor to wait for a lower entry price, which we will take the fair value, the 0.407 times P-book as a entry price. If its valuation corrects to 0.407, because its price to book and its book value now, is around 8 yuan, 8 yuan, renminbi 8 yuan, which is close to 8.8 Hong Kong dollars. So if we take 0.407 this fair value as an entry price, it would be 360 Hong Kong dollars. If its share price drops to 360, we think it's a good entry level. Okay, the other company we picked this in our part 3 is CNOOC. CNOOC is the largest producer of offshore crude oil and natural gas in China, and one of the largest independent oil and gas exploration and production companies in the world. The company mainly engages in exploration, development, production, and sale of crude oil and natural gas. This is the financial results of the company in the first quarter of 2024. So total revenues increased by 14.1%. Profit attributable to shareholders of the company increased even more by 23.7% to 39.7 billion yuan in the first quarter this year. Basic earnings per share increased also by the same by the same rate, 23.7% to 84 cents, 84 fund in the first quarter. Weighted average return on net assets was 5.79% in the first quarter, saw an increase by 0.54 percentage points. And the total of final dividend and interim dividend for 2023 are 1.25 Hong Kong dollar per share. Dividend yield is about 6.2% at current share price. Okay, in the first quarter, oil and gas sales realized price. The revenue from crude and liquid. So it has two business segments. One is crude and liquids exploration and sales of crude and liquids. The other is exploration and sales of natural gas. So in the first quarter, revenue from crude and liquid sales amounted to 78.2 billion, up 23.6% year-on-year. Also helped by, besides increase in output, crude and liquid output, it's also helped by the rise in average realized price in the first quarter. The average realized price of its crude and liquids in the first quarter was $78.75 per barrel, up 6.2%. However, natural gas was down 7.7% in the first quarter because in the first quarter, global natural gas also saw a decline. It was affected by the drop in natural gas price globally. But increase in natural gas output help its revenue grow despite the drop in realized price. Revenue from natural gas increased by 7.9% in the first quarter year on year to 11.774 billion yuan. Okay. All-in cost was well controlled and reduced by 2.2%. Why net profit increased more than the growth in revenue is partly due to the reduction in all-in cost, which was reduced by 2.2% in the first quarter. So this is a comparison. In first quarter of 2023, all-in cost was 28.22, and in first quarter this year, all-in cost was 27.59 US dollar per BOE. BOE stands for barrel of oil equivalent. That means to produce 1 barrel of oil equivalent. Last year in the first quarter, the cost was 28.22 US dollar. This year, first quarter, it was reduced to 27.59. So the lower the cost, the better the margin. Okay. Another plus was the strong production growth continue. In the first quarter, the company's net oil and gas production was 180 million barrels of oil equivalent, BOE, an increase of 9.9% year on year. It is due to because CNOOC has onshore and offshore overseas production. Okay, so growth in China. This part is the revenue. The oil and gas production from China. Growth in China mainly attributable to increased production from newly on-stream oil and gas fields, while overseas growth was mainly driven by production ramp-up in Guyana and Canada. Its overseas oil fields are quite diversified. It has oil fields in Asia, ex-China, also in Oceania, Guyana, Africa, North America, excluding Canada, and Europe as well. South America, it also has oil fields in South America. Okay. In the first quarter, it has 1 new discovery and 4 successful appraisals of oil and gas structures. This one is within China. This one is overseas, Bluefin. And its key project, Suizhong 36-1 Luda 52 oil field secondary adjustment and development project has been put into production, and other new projects are progressing smoothly. So we are quite confident that it will see continuous growth in oil and gas production. Okay. Oil price remain, although fluctuating between $70 and $90, it remains stable. And recently, because of geopolitical tensions, oil price holds about $80, which is in favor of CNOOC. Okay. What are the recommendation reasons behind CNOOC? First of all, the EIA forecasted global liquid fuels consumption averages 102.9 million barrels per day in 2024 and 104.3 million barrels per day in 2025, especially non-OECD Asian countries, particularly China and India, will drive global liquid fuels demand growth. And the ongoing recovery and positive trajectory of China's economy supports the demand for oil and gas. The offshore oil and gas serves as a significant growth driver for oil and gas production in China. So compared to PetroChina, CNOOC has more overseas oil fields So the offshore and also overseas oil and gas production and exploration will be a significant growth driver for CNOOC. OPEC Plus production cut to persist. In the recent meeting, OPEC Plus announced they will extend the production cut to 2025. This is poised to support oil price, and the IEA expects a shift from surplus to slight deficit for the global oil market in 2024. We expect sustained output cuts and from OPEC Plus, and geopolitical tensions will also lend support to oil prices, which could fully benefit CNOOC. Okay, so the share price also outperformed the market. You can see since January, the share price rose from around $12 to current share price is 21, around 21 Hong Kong dollars. Yet it is still trading below its peers. This red line represents the peers' average daily multiple in terms of price to book value. Sorry, the red line is CNOOC, whereas the white line, the red line is the peers, and the white line is CNOOC. It underperformed, lags behind that of its peers for the more since 2020, and entering 2024. It has caught up. You can see now the P/book has risen to 1.26 times. Okay, so if its share price now is a bit pricey, we will recommend to enter between $19.50 Hong Kong dollar and 20 Hong Kong dollar. If there's a correction to 1950, between 1950 and 20, it would be a good entry level with the dividend yield around close to 7%. Okay. Its ROA, ROE, and net profit margin and earning per share are much higher than the other two Chinese oil and gas companies, namely PetroChina and Sinopec. Okay, in terms of P/book, it's more expensive, more pricey. Now it's trading at 1.3 times P/book, whereas PetroChina is trading at 0.82 times, and Sinopec is even cheaper at 0.63 times P/book. But we because Sinopec is trading is cheaper in terms of P/book, its dividend yield is higher. Yet, in terms of ROA and ROE, there's a reason for its higher valuation. Its ROA is 12.3%, much higher than that of PetroChina and Sinopec. And ROE at 18.58% is also much higher than that of PetroChina and Sinopec. Net profit margin also much higher compared to PetroChina and Sinopec, and earning per share as well. So that's a reason. That's the reason why its valuation. The other two are still trading below their book value, while CNOOC is trading above the book value. We still will recommend CNOOC because of higher ROA and ROE, and is not really attracted to the lower valuation, particularly Sinopec. Okay. Okay. The third counter is CGN, China Guangdong Nuclear Power. It's the sole platform for nuclear power generation of China General Nuclear Power Corporation. It's a subsidiary of CGNPC. Okay, CGN Power builds, operates, and manages nuclear power plants. Abbreviation NPP. Sells electricity generated by these nuclear power plants and organizes to develop the design and research and development of NPPs. The company is the largest nuclear power developer and operator in China in terms of installed capacity in operation. There are two Zhonghe China Nuclear Power and two operators in China, CGN, China Guangdong Nuclear Power, and China Nuclear Power. And CGN is the largest nuclear power developer and operator in China in terms of installed capacity in operation. The company's share of installed nuclear power capacity in operation and under construction ranks number one in the domestic market. Okay, this is the equity structure. It's owned by CGN, its parent company, majority shareholder, owning 58.89% in the share in the company, and then Hang Jian Investment holds 6.79%. Other A-share investors own 10%. X-share investors own 21%. So the company is listed both on the Asian market as well as in Hong Kong. In the first quarter, total revenue increased by 4.88% to 19.182 billion yuan. Profit attributable to shareholders increased by 3.4% to 3.6 billion yuan. Basic earnings per share increased by 2.9% to 0.071 yuan per share. And weighted average return on net assets was 3.13%, a slight decrease of 0.08 percentage points. The final dividend for 2023 is 9.4 fund per share. Dividend yield is about 3.5%. So for CGN Power, the selling point is not that much on dividend yield. It's more on the future, the growth prospect, because it's of nuclear power development in China. As at the end of 2023, the company managed 27 nuclear power generating units in operation and 11 nuclear power generating units under construction, including 6 units which were entrusted to the company by the controlling shareholder of the company for management. Okay, so that's why I mentioned just now we are upbeat on the growth prospect, because besides the 27 nuclear power generating units which are already in operation, it has 11 nuclear power generating units under construction. Okay. This is the average utilization hours of renewable energy in China. That's for in the first quarter as a whole, for the whole country. Nuclear, the utilization hours is the highest, 1,828 hours, the average utilization hours. Second is thermal, 1,128 hours, and then followed by wind power, the utilization hours, average utilization hours, 596. Hydro is dependent on rainfall. Sometimes utilization hours is very dependent on rainfall. 555 hours in the first quarter this year. And solar also dependent on how much sunshine or the length of fine weather. The utilization, average utilization hours is the lowest among the 5 different types of renewable energies. Okay, this dividend distribution ratio is growing continuously. You can see here on the preconditions, there are no significant changes, and approval is obtained from the AGM of the relevant fiscal year. The company aims to achieve a moderate increase in the annual dividend ratio from 2021 to 2025 based on the dividend ratio in 2020. 2020 is 42.25%. So its dividend payout ratio has been increasing from 42.25% in 2020 to 44.26% last year. And it's expected to continue to increase to close to 50%, 48% payout ratio in this year and 2025. Okay, you can see absolute amount dividend per share also increased steadily from 2019 to 2023. Average utilization hours since 2023, its average utilization hours stood above 1,800. In the first quarter of 2023 was 1,835, and despite a slight drop in the first quarter year on year, the first quarter this year, its average utilization hours still stood above 1,800, 1,802. Okay. On-grid power generation in total and by region. The company, this is 2022, 23, and 24. 24, the total on-grid power generation was 51,814 gigawatt hour in the first quarter this year. And this is the regional distribution, geographical distribution. Most of its power, the company is known as China Guangdong Nuclear Power. So more than half of its power generation, on-grid power generation, comes from Guangdong. You can see here, 28,374 gigawatt hour. And then 6,657 gigawatt hour comes from Fujian. Also, another 5,000 from Guangxi, and then 12,169 from Liaoning. This is the geographical distribution of the company's power generation. Okay. Average market-based power tariff. Okay, the change in power tariff will affect the earnings of the company. If power tariff goes up, of course, the company will be able to earn more. But if power tariff comes down, the company will saw a decline in its profit. Yet in the last 3 years, you can see here, the company's power tariff remains rather stable, around 0.4 yuan per kilowatt hour Okay. Expected in-store capacity in operation managed by the company in the next 5 years. This is the growth prospect. This year is expected in-store capacity in operation expected to be around 31,756 megawatt. This is megawatt. Next year, it will grow, is expected to grow to 32,958. And in 2026, it will further increase to 35,368. 2027, it will reach 37,776 megawatts. And by 2028, it will be close to 39,000 megawatts. Okay, what are the recommendation reasons? The construction cost of nuclear power is high, accounting for 50% to 60% of the total cost. So the entry barriers are high. Okay, and pursuant to the Nuclear Energy Development and Prospects in China 2023, issued by the China Nuclear Energy Association in July 2023, China has retained its #1 position in the world ranking in terms of the size of nuclear power generating units under construction. The installed capacity of nuclear power generating units is expected to further expand in China, and the use of nuclear energy will play multiple roles. So China is very supportive of nuclear power, and it will build more nuclear power generating or nuclear power plants in the next 10 years. And being the largest player, CGN Power will stand to benefit from this expansion policy. Chinese and global energy industry is shifting towards green and low carbon development, and China strives to achieve carbon dioxide emissions peaking before 2030 and carbon neutrality before 2060, this so-called Shruntan, which provides us with broad prospects of nuclear power development. With both low valuation and high dividends, the company has a high investment cost effectiveness at the current point in time. The nuclear power industry and the hydropower industry have similar characteristics, such as high dividend yield and stable ROE, but the valuation level of the nuclear power industry is significantly lower than the hydropower industry, which belongs to the valuation depression in the power sector. China Electricity Council released the 2023-2024 National Electricity Supply and Demand Situation Analysis and Forecast Report. The report predicted that by the end of 2024, the national installed power generation capacity is expected to reach 3.25 billion kilowatts, a year-on-year increase of about 12%. And the new installed power generation capacity in 2024 will exceed 300 million kilowatts again. Taking into account factors such as the macroeconomy and energy electrification, it is estimated that the total electricity consumption in 2024 will be 9.8 trillion kilowatt hours, kWh, an increase of about 6% over 2023. Okay, so I think the overall picture is we expect more electricity consumption going forward, especially AI. It is believed that AI will spur electricity consumption. And China is more dependent on nuclear power than other countries. And CGN Power, being one of the largest player, will benefit from supportive policy from the government. According to the statistics from the 2023 National Power Industry Statistics Overview issued by the China Electricity Council, the CEC, as of December 31st, 2023, the installed capacity of nuclear power generating units in operation was 56.91 gigawatt in the PRC, accounting for only 1.9% of the total installed capacity of power generation. So the proportion of nuclear power still remains very small in China's national energy structure. So there's a lot of room for growth going forward. From first quarter 2024, share of nationwide installed nuclear capacity is 1.9%, and share of nationwide nuclear power generation is 4.64%. Okay, you can see in this table. Okay, share price like very similar to Bank of China and CNOOC. Actually, the share price outperformed the market this year, and yet it's still the white line represent 1816 CGN compared to its peers. It's only trading at 1 times, slightly higher than 1 times P/book, whereas the average the P/book of the market average is 1.53 times. So now the book value last year at the end of 2023 for the company for CGN was 2.24 yuan. Hong Kong dollar, it will be around 2.45 Hong Kong dollars. So if its valuation narrow, I mean the gap with its the market average narrow, we're not looking at 1.5 times P/book, moving up to 1.5 times P/book. We are looking at just 1.3 times P/book. There will be 30% upside in the share price. Currently, it's trading at 290. So we are looking at 350, target price of 350. Okay. CGN, the dividend yield now is 1.03 times, and there's another the China nuclear is a competitor is listed on the Shanghai market 601985. The people is 1.94 times higher than the market average. So we're looking at 1.3 times people to be the fairer valuation for the company. Dividend yield 4.2%, more attractive than CNNC listed in Shanghai. Operating profit margin also higher. Earning per share was 0.232 Hong Kong dollars. Okay, so this ends our presentation today. So in summary, today we have picked 3 companies to present to you. Among them are Bank of China, CNOOC, and CGN. Okay, last Miss Series 1 and 2, please provide access link to record the video. So our Singapore colleague, can you please provide access link to TP Lim? What's the difference of CGN with CGN New Energy? Yeah, CGN New Energy is not involved in nuclear power. Is involved in other renewable energy, for instance, solar power and wind power, namely these 2 energy type, new energy type. Would like to know what is my view and assessment of the impact on Chow Tai Fook in view of the article published yesterday about closing of its Shenzhen plant. Its share price dropped further to below $9.6 today. Yeah, we are watching closely the further development of this because of the slowdown in consumer spending in China. Chow Tai Fook, 80% of its revenue, more than 80%, comes from China. So it is probably impacted by the slowdown in consumer spending because in April, the retail sales in China only grew by less than 3%. If I remember correctly, it was only 2.9%. So jewelry and gold jewelry consumption will take a hit from the slowdown in consumer spending, and this may be the reason behind its decision to close its Shenzhen plant to control its costs. So we'll watch this development more closely and we'll update you in due course. Okay. There's one outstanding question about is there any leverage mineral ETF listed in Hong Kong last week. There's only one. This is a leverage gold ETF. Leverage gold ETF. Besides this, there are no other leverage mineral ETF listed in Hong Kong. Okay. So if there's no further question, I'll end here. Thank you.
Okay, as everyone can see, you can stand a chance to win attractive prizes when you invest in Hong Kong listed equities and ETFs with poems. Okay, now it's actually very simple, but I just want to go through some of the prizes that could be won first. The first prize is a pair of air tickets to Hong Kong worth about $800. Second prize is a one-night stay in Shangri-La Hotel Sentosa. Okay, and the third prize is a mystery gift from Chow Tai Fook. If you remember, we went through Chow Tai Fook as well as one of our value stocks, and we have some gift cards as well, which from Samsonite, Xiaomi, and Haidilao as well. Okay, so how do you enter this lucky draw? Well, every time you place a buy, you have a buy contract on poems. It basically entitles you to one chance. Now, what exactly is a buy contract? Basically, when you place a buy trade, when you place one buy trade, okay, the equivalent of that is one buy contract. But if you place one buy trade for the same counter, then it's amalgamated into one contract. So for example, if you bought one lot of Meituan, okay, 3690, and later on the same day you bought one lot of JD. These are two different counters. You get two buy contracts and you get two entries in our lucky draw because these are two different counters. Okay, if let's say you bought one lot of Meituan and then later on in the same day you bought another lot of Meituan, this is actually only one entry in our lucky draw because it will be amalgamated. Okay, and it's not by this example is just for one lot. If you buy three lots, it doesn't mean you get three. It doesn't mean you get three chances. Okay, and in order for us to even the playing fields a little bit, okay, clients who have traded in the Hong Kong market from 2nd January to 10th May and clients who have not traded in the Hong Kong market from 2nd January to 10th May will be separated into two separate draws, which means there are actually two pairs of tickets to be won, two night stays in Shangri-La Hotel Sentosa, and two gifts from Chow Tai Fook for everyone to win. Okay, so with that being said, I'm going to place the link to our promotion campaign inside the chat where everyone can see. You can refer to this if you need any more information. And also, additionally, we have a lot of information available for you to make an educated decision on what value stocks you want to buy. For example, you can join our Poland's Mobile Trade communities. You can view our strategy and stocks picks on this website as well, or you can sign up for Investor Notes by Phillip Hong Kong. All the links are available on our webpage. You can also view the replays on our YouTube channel as I posted inside the chat, and also some of our other webinars that we've held based on for Hong Kong macro. Okay, with that being said, we've come to the end of today's webinar. Do check out the investor notes by Phillip Hong Kong and do check out the replays by Mr. Wong. It's all available for free on our YouTube channel. And thank you everyone for coming out today. Thank you for your time. Don't forget that we have the last part of the 4-part series next Thursday as well. And everyone have a great day ahead. Thank you so much for coming. Thank you.